Hi, this is Atilla Yeşilada presenting for Real Turkey channel in a brand new studio. Today we're going to talk about American Central Bank Fed and how its monetary policy is hurting countries like Turkey. You may wonder, well, United States, Turkey, 10,000 kilometers. United States uses the dollar, Turkey uses the Turkish lira. What may be the connection? This is what I'm going to explain to you today. But first of all, a shout to our content partner, Economies, which graciously lent me the studio and sound system and is also editing this video. If you know Turkish, you gotta watch Economies videos, the premier economy and finance YouTube channel in Turkey. Okay, Fed monetary policy, how it hurts Turkey, and more broadly, most of the emerging nations, emerging markets. So this content is divided into three parts. First, what is it that Fed is trying to do, how long it will take, and what will be the impact on the American economy. Two, how is Fed's monetary policy echoing around the world? It's called the transmission mechanism. And third, the bulk of the presentation is about what Fed will do to Turkey in 2023 and possibly in 2024. Okay. The American Central Bank, Fed, is mandated to find a balance between inflation and full employment. That means its primary object is to fight inflation to the point where it doesn't want to create too much unemployment. At this point, United States unemployment is very low, so Fed is completely focused on inflation. Fed's objective is to bring down inflation, that is trend inflation, to 2% per annum, or to make sure that it is firmly headed in that direction, in the direction of 2%, and it will never come back. And it uses two tools to achieve this objective. First, to raise interest rates to slow down domestic demand. Two, reduce its balance sheet, that is, to sell the bills and bonds in its balance sheet and absorb the excess dollars from the market, which also works like monetary tightening or increasing the interest rate. Now, how long will Fed pursue this policy? Now, there's a disagreement between me and the futures markets. According to futures markets, and to a lot of investors, to the extent I can read their views, Fed is going to conduct monetary tightening until the end of the first half of 2023, and in the second half, we're going to see rate cuts again. That's what the futures market tell us. They expect at least one rate cut in the second half of 2023. I completely disagree with that as an economist, simply because American inflation is becoming entrenched. In other words, the problem is not the headline inflation, 8.5%, 9%, or producer price index, or even the core index, but the fact that the agents in the economy are starting to expect high inflation to prevail in the future, maybe 5 years in the future, 10 years in the future. This is called stickiness in inflation expectations. And it is like, you know, if a central bank fears something, well, two things. First, deflation, which is not the subject of this video. Second, sticky inflation expectations. I think Fed perceived that if it were not to fight inflation rigorously or vigorously in the next month, in the next year or two, inflationary expectations become entrenched. In simple words, next year unions would demand higher wage hikes for their members. So to prevent that, Fed has to be extremely hard to fight inflation. In my view, Fed will continue to raise interest rates through 2023, probably to the point of raising the policy rate to 4 to 4.5%, and then pause for about a year. That is not to cut interest rates. And finally, in the meantime, it will continuously absorb excess dollars in the market by selling mortgage bonds, mortgage securities, and government bonds and bills from its portfolio, which is going to reduce the supply of dollars in the world. Obviously, that's going to slow down the American economy. It might cause a recession, and it will lead to higher unemployment. Anyone who has watched Jay Powell's Jackson Hole speech has pretty much heard the same argument. Now, that's what the American Fed will do. and what it will happen to the American economy in the coming 12 to 24 months. And believe me, a brief recession, a shallow recession, is worth for achieving very low inflation. Otherwise, we go back to Carter years and the Volcker episode. So how is that monetary policy echoing around the world? Well, first of all, to give you a simple fact, 60% of world trade and financial transactions are conducted in the American dollar. So essentially, we all use the dollar. A lot of foreign debt is in dollar terms. In fact, I think dollar is the most frequently used currency when countries or companies borrow in foreign currencies. So American interest rates and the amount of dollars in the world has a direct impact on any country or company that uses dollars. Essentially, we're talking about three mechanisms here. The trade channel, that's how the slowing of the American economy affects its trading partners. The capital markets channel or financial channel, which is hot money flows from the United States to other countries and vice versa. And finally, the credit channel. That is what American banks will do in terms of their overseas lending decisions. Now, in all of these three aspects, Fed tightening, if it continues through 2023, is a nightmare for all the emerging markets, including China, possibly with the exception of Russia, which has sort of decoupled from the global financial system. Why? As I've said, all and every nation, including China, Turkey, Brazil, South Africa, Uganda, Mugambe, I don't know, has borrowed lavishly in dollar terms during the pandemic. So everybody has a lot of dollar debt to pay. And now we are talking about a situation where the interest rate on that debt continuously goes higher. So, the treasuries need to raise more cash, more taxes to pay off their maturing dollar loans. The companies will have to raise more cash flow too. The dollar index continues to strengthen against all the major and emerging markets currencies. Now imagine Atilla Yeşilada is a Turkish company. All of my revenues are in Turkish liras, but my part of my debt is in dollar terms. If the dollar appreciates via the Turkish lira, then I'll have to dedicate a larger portion of my total revenue to paying off my debt. So that's how dollar shortage affects emerging markets. And of course, United States is the biggest importer of the world, or number 2 after China. To the extent American economy slows, everyone that sells to United States, from China to OPEC to South Korea to Germany, suffer to some extent. This is essentially why emerging markets are in a very difficult position. They are hit not only by Fed's higher interest rates and the increasing scarcity of dollars, but also, unless they are commodity exporters, by the commodity and food price shocks. They have not dealt completely with the pandemic, as we see in the case of China, which still resorts to complete shutdowns to prevent the spread of the virus. And finally, their indebtedness has increased significantly during the pandemic. And all of these comes at a time when the global liquidity pool is drying and when the Ukraine war threatens to upset the global political balances. Already, Sri Lanka, has defaulted. Lebanon is in default. Argentina will probably go to default. In my view, Egypt and Pakistan and Bangladesh may be at the verge of default, and depending on how the future unfolds, they can default as well. The second problem is the poorest countries, and Turkey is among them, unfortunately, has to make the very difficult choice between servicing their debts and feeding the poor at a time when they can't borrow cheaply. You read the IMF report, you read the UN reports, world hunger is becoming a significant problem. In the winter, another 200 million people fall below the poverty or even the starvation line. So this is why I don't think the emerging markets are going to shine in the next 2 years. And in fact, we may see a complete shakeout with weaker emerging countries defaulting on their foreign loans, with thousands of indebted companies in emerging markets not being able to pay off their maturing loans or their debt. In Turkey, of course, the trade channel is not important. We do export to United States and import to United States, but losing that business is not going to change the overall picture too much. 10 years ago, when Turkey had a lot of hot money, that's a lot of foreign money in its swap, bond, and equity markets, Fed tightening would have been a major problem in that respect, in the sense that all that money swooshes out. It's happening already. I think since the beginning of the year, roughly $70 billion worth of hot money fled the emerging markets, bond markets, and that's going to continue. But that's not Turkey's problem, because all the hot money left Turkey during the episode of Mr. Berat Albayrak's tenure as the Economies czar. I have a lot of videos on that. I love Berat Albayrak. I can do 10 videos about him. He's so intriguing. Anyhow, so no trade. Hot money has already left Turkey. Why are we afraid of? Well, the credit channel. Turkey, this is an average. It changes from month to month, but has to service roughly $180 billion of debt, foreign debt, every year. Now, only 60% of that is in dollars, but it doesn't make a difference, because alongside Fed, the European Central Bank is also raising interest rate. So I didn't bother to mention them. In addition to this $180 billion, which we need to roll over every year, borrow again, we also have a current account deficit, which means our revenues from abroad is much shorter than our imports from abroad, which also needs to be financed. In the next 12 months, Turkey is looking at a current account deficit conservatively of 40 billion, possibly $50 billion, depending on the progress of energy prices. In other words, Turkish Central Bank, which is the ultimate financer of a nation's all foreign debts, needs to find $230 billion. It doesn't have that money. Its gross reserves are something like $100 billion. Its net reserves minus $60 billion. Its liquid or usable reserves only $35 billion. Turkey doomed to default? Not necessarily, but it's going to be very hard. This is how the situation breaks down. Out of this $180 billion, roughly 2/3 are trade loans. So I'm going to export to EU, but I need to, buy raw materials and produce the goods. So a bank extends me some loans for me to purchase the inputs and finish the production process, which I pay back when I export my goods. These loans are traditionally rolled over, obviously at a higher cost, at a higher interest rate cost, but there is no problem there. But 1/3 of the debt is what we call long-term debt or project debt, or debt which is not secured by any kind of trade flow. Those are very difficult to refinance, not only for Turkey, but for most emerging market countries. What makes Turkey's situation extremely difficult is that all three major rating agencies, Fitch, Moody's, and S&P, graded Turkey below the investment level, almost junk, and have negative opinions on the future of Turkey's economy and ability to pay its debt. So, what will happen as Fed raises interest rates? Two things will happen. First, anyone who can borrow from abroad will have to pay higher costs, which will have to be reflected to the domestic market, which means companies that produce goods on borrowed money will have to raise their prices. Banks will have to raise the interest rates on dollar and euro loans, which will obviously have a negative impact on economic growth. Two, a lot of banks and companies will choose to pay off their debts rather than borrowing at higher interest rates. And what will they do? They will go to the central bank and say, hey, look, here's the Turkish liras, give me my dollars because I'm going to pay off my debt. Now that's a significant problem because it reduces the central bank reserves, it reduces the amount of dollar liquidity in the country, and of course, when the supply of something goes down while the demand doesn't change, its price rises. I'm talking about exchange rate instability. I've done a lot of videos on Turkey's coming currency crash, and Fed interest rates accelerates that process. Central bank simply doesn't have the money if these redemptions increase about 10, 15 billion dollars. Even if these redemptions are rather limited, they're going to exert pressure on the currency, which is already undermined by people wanting to hold dollars and euros rather than Turkish lira, and they were accelerating inflation. A lot of Turkish banks would not want to renew their loans. Some of the Turkish companies which have foreign debt may default. At the end, Turkey's liquidity pool will shrink and the economy will suffer. In the worst case scenarios where energy prices rise and Fed raises interest rate above and beyond what's being currently expected by me at the very least, Turkey may have a currency crisis, which means the central bank simply doesn't have the money to pay Turkey's dollar and euro obligations, so it declares a payment pause, a moratorium. It's going to be a tough winter for Turkey, and my next video is probably going to be the global debt problem and how Turkey figures in the overall picture. Thank you very much for watching Real Turkey channel. This is Atilla Işlada. Once again, I want to thank Mesele Economy for lending their studio to me, and have a good day.